Welcome to the deep dive. Today we're kicking off an audio lesson focused entirely on stacking wealth.
That's right. And, right at the heart of building serious wealth is this concept that often gets overlooked, but it's incredibly powerful.
Mhm.
Compound interest.
Compound interest. Yeah, it's almost like this secret weapon for your money, isn't it?
Yeah.
Working away quietly.
Exactly. Multiplying your assets. You might have even heard that quote, sometimes attributed to Einstein, calling it the eighth wonder of the world.
Right. Sounds a bit like magic, maybe?
It can sound that way, but really it's just straightforward math with pretty extraordinary long-term results.
Okay, not magic, but powerful math. I like the analogy of planting a tree.
Yeah, that's a good one.
It starts small, you barely see the growth at first,
Right.
but give it time, consistent care, and it becomes this massive thing growing faster each year. That's compound interest, basically.
That's the essence of it. It's not just about saving, which is important, obviously. It's about making that saved money work for you, letting it grow on its own.
And is that really the big difference between people who build wealth and those who feel like they're always, struggling to catch up?
Often, yes. It's not always about having a massive salary. It's often about understanding this principle and actually using it, leveraging compound interest actively.
That's actually pretty encouraging. It means you don't need like special connections or a huge pile of cash to start.
Not at all. The key ingredients are really understanding how it works and then, crucially, being consistent, taking action.
So this audio lesson is designed to give us that understanding.
Precisely. We're going to dive into the strategies that successful investors use, look at the common mistakes that can slow you down, and basically map out a path to build a really solid financial foundation.
And time is the big amplifier here, right? The sooner you start.
The better.
Got it.
Time is your greatest advantage. So really, the best time to get started is right now.
Okay, let's dig in. Where do we start? Maybe the difference between simple and compound interest.
Good place to start. It seems like a small detail, but over, say, decades, the difference is huge. It creates this massive gap in where you end up.
Like those two gardens you mentioned, one gardener just harvests and replants the same amount,
Right, same seeds year after year, predictable garden size.
and the other lets the plants reseed naturally.
Exactly. So each year, there are more plants producing even more seeds. After a while, that second garden isn't just a garden, it's this thriving, massive ecosystem.
All because of that natural multiplication.
That's the difference. Simple interest is like the first gardener. Compound interest is the second. Let's put numbers on it. Say $10,000 earning 8% simple interest.
Ugh.
You earn $800 each year, flat. Over 30 years, that's $24,000 in interest. So your $10,000 becomes $34,000.
Straightforward, easy math. But what about that same $10,000 with compound interest? Same 8%, same 30 years.
Now it gets interesting. With compound interest, where the interest earns its own interest, that $10,000 grows to roughly $109,357.
Wow, okay, $34,000 versus over $109,000. That's a massive difference, over $75,000 more.
It really hammers home why letting your earnings work for you is so critical. It's not just about the initial money.
It's that interest on interest idea. It builds on itself, like a snowball rolling downhill.
Exactly. Simple interest just pays on the principal. Compound interest pays on the principal plus all the interest you've already earned. That creates the accelerating growth.
The snowball gets bigger and picks up speed.
Precisely.
Yeah.
And there are four key parts to making this engine run.
Okay, what are the ingredients?
First, the principal. That's your starting amount, your initial investment.
Got it.
Second, the interest rate. That's how fast it grows. Think of it like the slope of the hill for the snowball.
Steeper slope, faster growth. Makes sense.
Third is time.
Yes.
The longer it compounds, the bigger the effect.
Like,
A longer hill for the snowball.
okay, PRT. What's the fourth?
Compounding frequency, that's Anna. How often they actually calculate and add the interest back in. Daily, monthly, annually.
Wait, even how often they calculate it makes a difference.
Absolutely. More frequent compounding means the interest starts earning its own interest sooner. Even small differences add up. Let's take another example. $1,000 at 5% for 10 years.
Okay.
Simple interest is easy. $50 a year. Times 10 years is $500 interest. Total $1,500.
Right.
With annual compounding. Year one, you earn $50. Same as simple. But year two, you earn 5% on $1,050.
So slightly more. $52.50.
Exactly. That keeps happening. By the end of 10 years with annual compounding, you'd have about $1,628.89.
So about $129 more just from the interest earning interest. It doesn't sound huge over 10 years, but I can see how it starts to ramp up.
It demonstrates the principle perfectly. Those small extra bits snowball over time.
Okay, so there's actual math behind this, right? A formula.
There is. It looks a bit complex at first glance, maybe.
Yeah.
AP1 plus RNNT.
Whoa, okay. Yeah, let's break that down. A equals P.
Right. A is the final amount, which you end up with. P is the principal, your starting money.
Okay.
Or is the annual interest rate, but as a decimal.
Well, yeah.
So 5% is 0.05.
Yeah.
N is the number of times it compounds per year. So annually, N1, monthly, N12, daily, N365.
Okay, N is frequency. And T.
T is time, in years.
Yeah.
How long the money is invested.
A equals P times 1 plus R divided by N raised to the power of N times T. Okay, and the exponential part is that power.
Exactly. That end exponent is where the acceleration comes from. It shows why time has such a huge impact. More time, more compounding periods, more chances for growth to build on itself.
So it's not just steady growth. It starts slow and then really picks up speed later on.
Precisely. You can almost think of the compound interest journey in 3 phases.
Okay.
Phase 1 is the initial phase. Growth seems kind of slow, maybe even modest. This is where people sometimes get discouraged. They don't see big results right away.
Yeah, I can see that, thinking, is this even working?
Right. But then you move into the building phase. Here, the accumulated interest really starts generating noticeable returns. You begin to see that acceleration we talked about.
Okay, things start picking up.
And finally, you hit the exponential phase. This is where the real magic, so to speak, happens. The pile of accumulated interest is so large that it generates significant returns all by itself. That's when the growth curve goes almost vertical.
That's the goal. Is there a quick way to estimate how long it takes for your money to double without doing that whole formula?
There is a really useful little mental shortcut called the Rule of 72.
Rule of 72.
Okay, it's simple. Just take the number 72 and divide it by your annual interest rate as a percentage. The answer is roughly how many years it'll take for your investment to double.
Seriously, that easy. So if I'm getting, say, 6% a year, 72 divided by 6, that's 12. It takes about 12 years to double.
Approximately, yes. And if you were getting 9%.
72 divided by 9.8 years. Wow.
See, it really highlights how even a few percentage points difference in your return rate can drastically change how quickly your wealth grows.
That rule of 72 is brilliant. Super practical. Okay, so we understand the principle, the math. How do we actually put this into action? How do we maximize it in our own lives?
Right. The real power comes from applying it strategically. It's about where you put your money and how you manage those investments. Those choices make a huge difference long term.
So it's not just about finding any account that compounds. It's about being smart about which ones.
Exactly. Your basic savings accounts, CDs, they compound through interest. That's the foundation. But then think about brokerage accounts. Reinvesting dividends is a big one.
Reinvesting dividends, explain that a bit.
Sure. When companies you own stock in pay out dividends, instead of taking the cash, you can set it up to automatically use that money to buy more shares of the same stock.
Ah, so you get more shares.
Which then generate even more dividends next time. It's compounding right there within your stock investment. A very powerful cycle.
Automatic dividend reinvestment. Sounds like a set-it-and-forget-it way to boost growth.
It's a fantastic tool, yeah.
Yeah.
But we have to remember, compounding isn't always your friend.
Right, the dark side. Debt.
Exactly. Credit card debt, especially. Those super high interest rates compound, often daily, making it incredibly hard to pay off. Student loans, too, interest can accrue while you're in school, then get added to the principal, so you end up paying interest on the interest.
Ouch. A painful reminder that the math works both ways. So, focusing on the positive side again, what are the key strategies to really make compounding work for us?
Okay, number one, absolutely critical. Start early. We can't stress this enough. Even small amounts invested in your 20s can potentially grow way more than much larger amounts invested later, just because of that extra time.
Time is the magic ingredient. We'll definitely dive deeper into that. What else?
Consistency. Reinvest everything. Make sure those earnings go right back to work generating more earnings.
Don't just let dividends sit as cash.
Right. Also, choose investments that actually match your timeline and how much risk you're comfortable with. Someone young, decades from retirement, can usually handle more market ups and downs than someone nearing retirement.
Makes sense. Tailor it to your situation.
And crucially, watch those fees. Minimize them. Even tiny fees drag down your compounding over the long haul. We saw how big an impact they can have.
Fees are like friction on that snowball, slowing it down. What about taxes? How did they fit in?
Taxes are huge. Tax-advantaged accounts like 401ks, IRAs, HSAs are incredibly valuable here. They let your investments grow without getting hit by taxes every single year.
So in a normal brokerage account, you pay taxes on interest or dividends or gains each year, and that reduces the amount left to compound.
Exactly. That money goes to taxes instead back into your investment pot to grow further.
Okay.
But in a tax-deferred account, like a traditional 401k or IRA, it all grows tax-free until you take it out in retirement.
And Roth accounts.
Roth IRAs, Roth 401k.
Yeah.
You put in money you've already paid taxes on, but then the growth and the withdrawals in retirement can be completely tax-free. That's incredibly powerful.
So the tax treatment makes a massive difference to the final amount.
A substantial difference, yeah.
Yeah.
Especially over decades. So it's not just what you invest in, but where you hold those investments, which type of account.
Got it. And the final key strategy.
Patience. Compound interest rewards patience and a long-term view. The really big gains often don't show up for many years. You might not see huge growth early on, but you have to stick with it. Let time do its work.
Okay, let's really double down on that point about time and consistency. You said they're the most powerful drivers.
Absolutely. Think about those two neighbors again.
Right.
Planting apple trees.
Right.
One starts in spring, prepares the soil, waters it every day. Diligent. Consistent.
Yes. Okay.
The other waits till summer, waters it. Sometimes. Sporadically.
I can guess how this ends.
Yeah. 20 years later, the first neighbor has this big, healthy tree, tons of apples every year. The second neighbor, maybe a smaller tree, much less fruit, if it even survived.
So the lesson is?
It's a simple but profound financial truth. Starting early and being relentlessly consistent with your investing, those two things create dramatically different outcomes thanks to compounding.
It seems almost too simple, but the numbers back it up, right? Let's talk more about that early bird effect.
Right. Starting in your 20s versus your 30s or 40s. It's not just a few extra years. It unlocks the exponential power over a much longer time frame. The math advantage is huge.
You had some figures on this earlier, comparing starting ages.
Yeah, let's revisit that. Say someone starts investing $200 a month at age 25. By age 65, assuming a reasonable average return, they put in $96,000 total. But compounding could grow that to maybe around $878,000.
Okay, nearly $900K from $200 a month. Impressive. What if someone waits until 35?
Okay, they start at 35. To catch up, they invest double, $400 a month. By 65, they've invested more total money, $144,000.
Wow.
But because they had 10 fewer years for compounding,
They end up with less.
significantly less, maybe around $619,000.
Wow.
Yeah.
Invested almost $50K more, ended up with over $250K less, just because they started 10 years later.
Exactly. And it gets worse if you delay more. Start at 45, invest $800 a month, that's $192,000 total. Invested, you might only end up with around $373,000. Those early dollars have so much more time to work and multiply.
It's like giving your money a longer runway for takeoff. Those first years are the most powerful.
Absolutely. And it's not just the math. Starting young has psychological benefits too.
Like what?
You build good financial habits early. You generally have a higher tolerance for risk because you've got decades to recover from downturns.
Right. Market drops feel less scary when retirement is 40 years away.
Exactly. Which means you might be comfortable with more growth-focused investments. Plus, starting early means less pressure later. You don't feel like you have to play catch-up with huge contributions. More flexibility.
You also mentioned a story, Warren's story. Someone who started small but early.
Yeah, a hypothetical example, but based on the principle. Let's say Warren starts his first job at 22, invests just $50 a month. Tiny amount. But he does it consistently. Through ups and downs, job changes.
Yeah.
Just keeps doing it. By age 60, maybe his portfolio is worth over $1.2 million.
From $50 a month.
It wasn't about hitting home runs or huge contributions. It was starting super early and being incredibly consistent for nearly 4 decades. That's the power.
That's incredibly motivating. It shows it's accessible. So how do we actually do that consistency part? How do we make systematic investing work?
Well, there's always this debate. Lump sum versus regular investing. Put all your money in at once or drip it in over time.
Which is better?
For most people, especially for long-term wealth building, the consistent, regular approach is usually more practical and, frankly, easier emotionally. This brings us to dollar cost averaging, or DCA.
DCA. Okay, what exactly is that?
It's simple, really. You invest a fixed amount of money into something, say an index fund, at regular intervals, like $200 every month, regardless of whether the market is up or down that month.
So you ignore the price swings and just buy regularly. What's the advantage?
Well, think about it. When the price is low, your fixed $200 buys more shares. When the price is high, it buys fewer shares. Over time, this tends to lower your average cost per share compared to trying to guess the perfect bottom.
Okay. You average out the purchase price.
Right. And crucially, it takes the emotion out of it. You're not trying to time the market, reacting to news or fear. You just stick to the plan.
Hmm.
It also reduces the risk of dumping all your money in right before a big drop.
Smooths out the ride, like Amanda and Robert.
Exactly. Amanda invests $1,000 a month, every month, for a year. 12K total. Robert holds his 12K trying to pick the perfect moment. Long term, Amanda's consistent, unemotional DCA approach usually wins because timing the market perfectly is incredibly hard, bordering on impossible. She benefits from buying during dips.
Makes sense. Takes the stress out of it, too. What of the psychology of just doing it regularly?
That's a big part of it. Investing regularly gives you a sense of progress. It reinforces good habits. It becomes normal, like paying a bill. You're less likely to spend impulsively if you know that money is already earmarked for investing.
Like training for a marathon, consistent runs beat occasional sprints.
Perfect analogy.
Yeah.
And the key to making this happen easily, automation.
Setting up automatic transfers.
Absolutely crucial. Set up an automatic transfer from your checking account to your investment account each month or each payday. Treat it like any other bill. The money moves and gets invested without you having to think about it or get tempted to skip it. That's how you ensure consistency.
So automation is the bedrock of consistent investing.
Okay, fast forward. You've been doing this consistently for years, maybe decades. What happens next? You mentioned an acceleration phase.
Yes, the acceleration phase. Sometimes people call it the hockey stick curve because of how it looks on a chart. This is the really exciting part. It's the point where the money your investments are earning each year starts to become bigger than the new money you're actually contributing.
Wait, so the investment growth itself starts to do the heavy lifting, more than your savings.
Exactly. The compounding effect really takes over. Your wealth starts growing much, much faster because the base is so much larger.
That sounds like the turning point everyone's aiming for. When does that typically kick in? It varies, of course, depends on returns, contribution amounts. But often, you start to see this noticeably after about 15 to 20 years of consistent investing. It means your accumulated gains are now a major engine of future growth.
Can you give an example? Like Patricia.
Sure. Patricia starts investing $300 a month at 25. For the first 10, 15 years, it grows steadily. Maybe not spectacularly, but around year 15, maybe the earnings from her portfolio in that single year exceed the $3,600 she contributed, $300 by 12.
So the investments made more money than she put in that year.
Right. And maybe by year 20, the annual earnings are more than her total contributions over the previous 5 years combined. That's the acceleration.
That's dramatic. But those early years, they can feel slow. How do people stay motivated when it doesn't feel like much is happening?
Patience and perspective are key. You have to understand that those early, seemingly slow years are building the essential foundation. It's like building a skyscraper.
How so?
A huge amount of work goes into the foundation, deep underground. You don't see much progress above ground for a while, but that massive, solid foundation is what allows the tower to eventually shoot up quickly and safely.
So focus on the process making the contributions, not just the early results.
Exactly. Set realistic expectations early on. Focus on consistency. Celebrate small milestones, maybe. Visualize the long-term goal. Maybe connect with other investors for support. Don't get obsessed with daily market moves.
How often should you check your progress then? Avoid daily checking.
Definitely avoid daily, even weekly checking. That just breeds anxiety and emotional reactions. Maybe check in monthly or quarterly. Enough to stay informed and make sure you're on track, but not so often you get caught up in the noise.
So it comes back to that synergy. Start early for time, invest consistently to fuel it, and be patient to let the acceleration phase happen.
That's the formula. It's not about getting rich quick. It's reliable, powerful growth over the long term. Stick to the plan, avoid the big mistakes, and let compounding do its thing.
Okay, let's get practical now. What should people actually invest in to make this compounding work best? That's the million-dollar question, right?
Maybe literally.
Yeah.
Yeah, choosing the right investment vehicles is crucial. It really dictates how effectively compounding works for you. Where you put your capital can be the difference between okay growth and building serious, lasting wealth.
You had that James and Maria example.
Right. Both start with $10K. James plays it super safe, puts it in a low-yield savings account. Maria diversifies maybe some index funds, dividend stocks, uses tax-advantaged accounts.
And after 25 years?
James might have, what, $11,300? Very little growth. Maria, using compounding across different assets and accounts, could potentially have well over $100,000, maybe much more depending on returns.
That's a staggering difference just from choosing where to put the money. So, where do people typically start building this portfolio?
Often the foundation is built with fixed income investments. These are generally more stable, offer more predictable returns than stocks, say, good for stability, especially as you get closer to needing the money.
Okay, fixed income. What falls into that category?
Things like high-yield savings accounts. They're safe, usually FDIC insured, easy to access. Returns are lower, maybe 1–2% historically, but great for emergency funds, short-term goals,
Right, safety and access. What else?
certificates of deposit CDs. You usually get a slightly higher interest rate than savings accounts, but you have to lock your money up for a set term, few months, few years.
CDs. And you mentioned CD laddering. What's that?
It's a smart strategy. Instead of putting all your money in one long-term CD, you split it up. Say you have $12,000. You could put $3,000 into a 3-month CD, $3,000 into a 6-month, $3,000 into a 9-month, and $3,000 into a 12-month.
Okay, different maturity dates.
Right, so every 3 months a CD matures. You can then either access that cash if you need it or reinvest it, maybe into a new 12-month CD to potentially get a better rate. It gives you flexibility and potentially better returns than just short-term CDs.
A ladder of maturing funds. Clever. What about bonds?
Bonds are another key fixed income type. Corporate bonds loans to companies, especially investment-grade ones, might yield 3–6% historically. Government bonds like U.S. Treasuries offer lower returns, but are considered extremely safe, virtually no default risk.
Okay, corporate versus government. And you mentioned TPS.
Yeah, Treasury inflation-protected securities. These are interesting. Their principal value actually adjusts with inflation based on the Consumer Price Index, CPI.
So they protect your purchasing power.
Exactly. The interest is paid on the adjusted principal. So if inflation is high, your investment value and interest payments keep pace. Very useful for preserving real wealth, especially when inflation is a worry.
So with all these fixed income options, there's a trade-off. Risk versus return.
Generally, yes. Higher potential yield usually means higher risk. High-yield corporate bonds, for example, might come from less financially stable companies. Government bonds are safer, but offer lower returns. It's about balancing safety, return, and liquidity, how easily you can get your cash based on your goals, timeline, and comfort level with risk.
Okay, so fixed income provides the stable base. How do we kick things into higher gear? How do we really accelerate wealth with equities, with stocks?
Right, the stock market. This is where you often find the biggest potential for long-term growth, maximizing compounding through two main ways: capital appreciation, the stock price going up, and reinvested dividends.
And you mentioned index funds earlier as a good way to access this.
Hugely powerful, yes.
Yeah.
Especially low-cost index funds tracking broad market indexes,
Yeah.
like the S&P 500.
S&P 500 tracks the 500 largest U.S. companies, right?
Exactly. So you instantly own a tiny piece of hundreds of major companies across different industries. Great diversification, usually very low fees, which we know is crucial. And importantly, they typically automatically reinvest the dividends paid by those companies right back into the fund.
Buys more shares of the index fund automatically. And what kind of returns have those seen historically, long term?
Long-term, broad market index funds have historically averaged somewhere in the 7–10% per year range. Of course, some years are way up, some are down, but that's a typical long-term average. And often, this simple passive approach beats most actively managed funds, especially after you factor in the higher fees of active management.
So low cost, diversification, automatic reinvestment seems like a solid starting point. What about picking individual stocks, especially ones that pay dividends?
That's another valid strategy. Using dividend reinvestment plans, or DRPs. Like we touched on, the dividends buy more shares of that specific company. Direct compounding.
You own more shares, you get bigger dividends next time.
Precisely. Let's say you have $10 in a stock with 3% dividend yield. That's $300 a year. With a DRP, that $300 automatically buys more shares. Next year, your 3% dividend is calculated on your slightly larger number of shares.
It's very direct, very tangible compounding.
It is. And psychologically, seeing those dividends come in, even if reinvested, can feel good. It shows the investment is working, can make it easier to stick with it during market dips. Some people focus on dividend aristocrats.
Dividend aristocrats. Sounds fancy.
Yeah. They're companies with a long, proven history of consistently increasing their dividend payouts year after year. Can be attractive for reliable compounding income.
Okay. What about stocks that don't pay dividends? Like tech companies often reinvest everything back into growth.
Right, growth stocks. Think Amazon, Apple in their high growth phases. Here, the compounding comes mainly from the stock price appreciating significantly over time. The company reinvests its profits in R&D, expansion, etc., aiming to become much bigger and more valuable. The payoff for investors comes from the rising share price, not dividends.
So two paths in stocks: dividend reinvestment or capital appreciation from growth, both driven by compounding in different ways.
Exactly. And remember, market volatility, those ups and downs, while scary sometimes, they actually help dollar cost averaging work. When prices dip, your regular investment buys more shares, potentially boosting your long-term returns when prices recover.
Okay, we've got fixed income for stability, equities for growth. How do we, like, supercharge this whole thing, make it even more effective?
Now we bring back the power of taxes. Or rather, avoiding them as much as legally possible while your money grows. Tax-advantaged accounts are the key here.
Right, 401ks, IRAs, HSAs, you said they avoid the annual tax drag.
Exactly. Let's look at a traditional 401k first, the kind you often get through work. 3 big advantages.
Yeah.
1, your contributions are usually tax-deductible now, lowers your current taxable income. 2, employer match. If your company offers a match, that's free money, an instant return that starts compounding immediately. Huge benefit.
Always take the match if you can.
Got it.
Third advantage.
Tax-deferred growth. All the dividends, interest, capital gains inside the 401k grow without being taxed year after year. You only pay taxes when you withdraw the money in retirement.
Okay, tax deduction now, potential match, tax-deferred growth, powerful. What about IRAs, individual retirement accounts?
IRAs offer more investment flexibility. A traditional IRA works similarly to a 401k, tax-deductible contributions, usually depending on income, and tax-deferred growth. The Roth IRA is different.
How so?
With a Roth, you contribute money you've already paid taxes on, after tax. But the big payoff is all the growth and all your qualified withdrawals in retirement are completely tax-free.
Tax-free growth and tax-free withdrawals. That sounds amazing.
It's incredibly powerful for long-term compounding. You know exactly how much money you'll have in retirement, no tax surprises later. You have that example earlier comparing taxable versus tax advantage.
Yeah, remind us, $10K, 8% return for 30 years.
Right. Investor A uses a regular taxable account, pays 25% tax on gains each year. Investor B uses a tax-advantaged account, no annual taxes. After 30 years, Investor B, thanks to tax-free or tax-deferred compounding, could easily end up with 25%, maybe even 35% more money than Investor A, just from avoiding the annual tax hit.
Hundreds of thousands of dollars difference, potentially. It really shows the power of the account type.
Yeah.
What about HSAs, health savings accounts?
HSAs are unique. If you're eligible, usually requires a high deductible health plan. They have a triple tax advantage.
Triple.
Yep. 1, contributions are tax-deductible. 2, money grows tax-free. 3, withdrawals are tax-free if used for qualified medical expenses.
Okay, great for healthcare costs, but for compounding.
Here's the kicker. After age 65, you can withdraw HSA money for any reason without penalty. You'll pay regular income tax on non-medical withdrawals then, just like a traditional IRA, but the growth up to that point was tax-free. It makes HSAs an incredibly potent long-term investment vehicle alongside their healthcare purpose.
Wow, so HSAs are like a secret retirement account too?
In a way, yes. Very flexible. Understanding your tax situation now and where you expect to be in retirement can help you decide the mix of traditional tax-deferred versus Roth tax-free contributions that make sense for you. Using both can be a smart strategy.
Definitely seems crucial to use these tax-advantaged accounts to their full potential. Okay, beyond stocks, bonds, and these special accounts, are there other ways to get compound interest working, maybe less traditional options?
Absolutely. Once you have a solid foundation, you can explore alternatives. Real estate is a classic example.
How does compounding work there?
2 ways, really. First, the property value itself might appreciate over time, capital growth. Second, if it's a rental property, it generates income. You can use that rental income to pay down the mortgage faster, save for another property, or reinvest elsewhere. It's like a dual compounding engine.
Property value grows and income can be reinvested, makes sense. But owning property directly is a lot of work.
It can be. For easier access, there are REITs, real estate investment trusts. Yeah, there are companies that own or finance income-producing real estate. You buy shares like a stock. They're legally required to pay out most of their taxable income as dividends to shareholders. Those dividends can often be quite high, maybe 4–8%, and you can reinvest them to buy more REIT shares. So you get real estate exposure and compounding through dividends.
Okay, REITs offer a simpler way into real estate compounding. What else?
Peer-to-peer, P2P lending platforms. You lend money directly to individuals or small businesses through an online platform and earn interest.
You become the bank, basically.
Sort of. You can potentially earn higher interest rates than traditional savings. And the compounding comes from reinvesting the interest payments you receive into funding new loans. Spread your money across many loans to diversify. But there's definitely more risk here borrowers can default.
Higher potential return, higher risk seems to be a theme with alternatives.
Exactly. Due diligence on the platform and lots of diversification are key. Then you have crypto and digital assets.
Ah, the Wild West.
Can feel like it. Very volatile, high risk. But things like staking crypto or yield farming can offer potentially very high annual yields APY, sometimes 5%, 10%, 20%, or even more. Again, compounding happens if you reinvest those earnings. But this should be a small part of a portfolio, if at all, and requires serious understanding of the risks.
High risk, high potential reward needs expertise. Got it. Any others, maybe for bigger investors?
Private equity and venture capital. Investing in private companies. Requires significant capital, long holding periods. But the potential for compounding through business growth, operational improvements, and eventually selling the company or taking it public can be substantial.
So with all these alternatives, real estate, REITs, P2P, crypto, private equity, what's the main takeaway?
The key things to remember are higher potential returns usually come with higher risk, less liquidity, harder to get your money out quickly, and often longer time horizons. They can offer diversification benefits, but you absolutely must do your homework. Thorough due diligence is critical.
So it's not about finding the one magic bullet investment.
Definitely not. Success comes from building a diversified portfolio across different asset classes, traditional and maybe some alternatives that aligns with your specific goals, risk tolerance, and timeline, and consistently letting compound interest work within each part of that portfolio.
That makes sense. Build the foundation, then maybe add some spice carefully. Now, we've talked a lot about how to make compounding work. Let's flip it. What are the common mistakes people make that actually slow down or sabotage this whole process?
This is so important because sometimes small mistakes or just inaction can quietly derail your financial future. What you don't do, like avoiding high fees or emotional decisions, can be just as crucial as what you do.
Like hidden roadblocks.
Exactly. They chip away at your progress, often without you realizing the full impact until years later when you look back at the potential growth you missed. Avoiding these errors is essential if you're serious about long-term wealth building.
Okay, what's a big one? Fees.
Fees are a huge, often underestimated enemy of compound interest. Think of them as compound interest working in reverse against you. A 1% or 2% annual fee might not sound like much.
But it adds up massively over time, right? You had that example, $100 K at 8%.
Yeah. Over 30 years, no fees, it's over $1 million. With just a 0.1% fee, slightly less, around $1,004,000. But with a 1% annual fee, it drops to maybe $761,000. And a 2% fee, down to around $574,000.
Hundreds of thousands of dollars just gone, vaporized by fees.
Exactly. Wealth that could have been yours. And there's so many types of fees lurking.
Like what?
Transaction fees when you buy or sell.
Yeah.
Account maintenance fees. Load fees on some mutual funds. 12B1 fees for marketing. Advisory fees if you pay an advisor based on assets. Platform fees. Custody fees. The list goes on.
Wow. It sounds like a minefield. Are they always obvious?
Often not. They can be buried in the fine print of prospectuses or agreements. Some products, like certain variable annuities, are notorious for having multiple layers of fees that can easily add up to 3% or more per year. At that level, fees are eating a huge chunk of your potential return.
So what can people do? How do you fight back against fees?
You have to be proactive. Audit your accounts. Ask for clear fee disclosures. Scrutinize everything. Pay close attention to the expense ratio on mutual funds and ETFs.
Expense ratio, that's the annual percentage fee the fund charges.
Right. And it varies wildly. A low-cost index fund might have an expense ratio of 0.03%. An actively managed fund might charge 1% more. Over decades, that difference is enormous, especially since most active funds don't consistently beat the index anyway after fees.
Yeah.
Prioritize low-cost options.
Do a fee detective. Got it. Okay, fees are one major drag. What else trips people up? Psychology, emotions.
Oh, definitely. Behavioral mistakes, the things our own brains trick us into doing, can be even more costly than fees. Our built-in responses to fear and greed are terrible guides for investing. Understanding these biases is key to staying disciplined.
What are the classic emotional traps?
The big one is emotional investing. Market tanks. Fear takes over. People panic sell, often right at the bottom. Then the market booms, greed kicks in, people pile in near the top, afraid of missing out. Buying high and selling low, the exact opposite of what you should do. It devastates long-term returns.
You mentioned David's story earlier. Selling in the 2008 crisis.
Yeah. He had a good portfolio, but the crash scared him. Sold everything, went to cash, felt safe, but then he waited too long to get back in, missed a big chunk of the recovery. That single emotional decision likely cost him hundreds of thousands in lost growth. Very common, unfortunately.
Painful. What's another psychological pitfall?
Analysis paralysis. There are so many options, so much news. People get overwhelmed and just freeze. They delay investing, waiting for the perfect time or perfect information, which never comes. Meanwhile, valuable compounding time is lost, sitting in cash that barely grows. Remember, time in the market beats timing the market.
So fear of making a mistake leads to the mistake of doing nothing. How do you combat these emotional traps?
Having a system helps enormously. Create a written investment policy statement, your goals, risk tolerance, strategy. Put it down on paper. Automate your investments like we discussed. Takes the decision-making out of it each month. Set rules for rebalancing so you're not reacting emotionally. Maybe work with a good fee-only financial advisor for objective advice and behavioral coaching. And crucially, have that emergency fund. Knowing you have cash for emergencies stops you from panic selling investments when life throws a curveball.
System, automation, advisor, emergency fund, practical ways to keep emotions in check. Okay, besides fees and emotions, what about the actual investment choices people make? Can those limit growth?
Absolutely. Choosing investments that don't align with your timeline or goals is a common mistake, especially younger investors being too conservative.
Too safe. How does that hurt?
They might put too much in bonds or cash because they fear short-term market drops. But with decades ahead of them, they're sacrificing potentially much higher long-term growth from stocks just to avoid temporary volatility. It limits their ultimate wealth potential.
Risk aversion taken too far, basically.
Exactly. Take two 25-year-olds investing the same amount. One goes super conservative, maybe 70% bonds, 30% stocks. The other goes more growth-oriented, maybe 80% stocks, 20% bonds. By retirement age 65, the one with higher stock allocation is likely to have a significantly larger portfolio, even with more bumps along the way.
What about diversification mistakes?
Poor diversification is another big one. Sometimes people concentrate too much in one thing, like their company stock. Very risky if that company struggles. Or they think they're diversified because they own lots of different funds, but those funds all invest in similar things, like large U.S. tech stocks. That's not true diversification.
So true diversification means?
Spreading across different types of assets, stocks, bonds, real estate, maybe alternatives. Across different regions, U.S., international. Across different styles, large companies, small companies, growth, value. That helps manage risk properly.
So for most long-term investors, especially younger ones, having a good chunk in stocks is pretty essential for maximizing that compound growth, even with the short-term noise.
Overwhelmingly, yes. History shows stocks provide superior long-term returns needed to really drive compounding. Yeah. Despite the volatility. You just need the discipline and time horizon to ride it out.
Okay, so avoid high fees, manage emotions, make appropriate diversified investment choices. Those seem like the keys to avoiding self-sabotage. Now, let's pivot to action. How do people build their own personal blueprint for success?
Right, because delaying action is costly. Studies show even delaying starting small monthly investments by just a few years can cost you tens, even hundreds of thousands in lost potential growth over your lifetime. That missed compounding time is irreplaceable.
The cost of hesitation is real, so the first step is getting started. How? With a blueprint.
Exactly. A personal compound interest blueprint. It's your customized roadmap. It translates all these principles into specific actions for your life, your goals, your comfort level with risk.
Not a generic plan, but tailored, like Amanda's journey.
Yeah. Amanda felt overwhelmed. So she started by just figuring out her numbers. Income, expenses. How much could she realistically save and invest each month? Then she set specific goals, maybe $1.5 million for retirement by age 65. That target helped her figure out roughly how much she needed to invest and what kind of return she'd need to aim for.
So the blueprint connects today's reality with tomorrow's goals. What are the essential pieces of this blueprint?
First, you need a clear picture of your starting point. Document everything. Income, expenses, fixed and variable, existing investments, all debts and their interest rates, your emergency fund status, any big short-term needs coming up. Get it all down.
A full financial snapshot. Okay, then what?
Then, set clear, measurable goals. Short-term, 1 to 2 years. Medium-term, 3 to 10 years. Long-term, retirement, etc. Be specific. Write them down. Having multiple goals is fine. Just prioritize. Then you need realistic return expectations and an honest assessment of your risk tolerance. Look at historical averages for stocks and bonds, but also know yourself how much volatility can you stomach without panicking. That shapes your asset allocation.
Okay, blueprint drafted. Now actually building the foundation to make it happen. What are the first practical steps?
Before you dive deep into investing, you need that solid foundation. Number one, the emergency fund. We keep coming back to this because it's crucial. 3 to 6 months of essential living expenses in cash, easily accessible.
Why is this so non-negotiable?
Because life happens. Job loss, medical bills, car trouble. If you don't have cash set aside, you might be forced to sell your long-term investments at the worst possible time, disrupting your compounding and potentially locking in losses. Michael's story, remember?
Right, built the $15K emergency fund first, then lost his job. That fund saved him from touching his investments.
Exactly. It's insurance against disrupting your plan. Second foundational piece, tackle high-interest debt. Anything over, say, 8–10% interest. That's usually a guaranteed negative return. Paying that off is often a better financial move than investing, at least initially.
But should you stop investing completely while paying debt?
Not necessarily. The 80–20 approach can work. Maybe 80% of extra cash goes to debt, 20% still goes to long-term investments, like getting an employer 401k match. Keeps momentum going on both fronts. Once the emergency fund is solid and high-interest debt is managed, then you focus on which accounts to use.
Account selection priority.
Generally, yes. First, grab any employer match in your 401k or similar plan that's free money. Then max out tax-advantaged accounts like IRAs, traditional or Roth, and HSAs if you're eligible. After those are filled, then use regular taxable brokerage accounts for additional investing.
Maximize the tax advantages first. And the final piece of the foundation.
Automation. Set up those automatic contributions. Pay yourself first. Make investing a regularly non-negotiable deduction like your rent or mortgage. It ensures consistency without willpower.
Okay, recap foundation. Emergency fund, tackle high-interest debt, prioritize tax-advantaged accounts, automate contributions. Foundation built. Now, executing the strategy day to day.
Right, moving into implementation. This means choosing specific investments and how you'll manage them. Keep it simple initially. Broadly diversified, low-cost index funds, or ETFs, are a great starting point. Easy, effective. Then you need a system for regular review and rebalancing.
How often should you review and rebalance?
Daily is way too much. Quarterly is often a good rhythm for many people. Check if your asset allocation, your mix of stocks, bonds, etc., has drifted too far from your target. Review performance, costs, adjust contributions if needed. See if you're still on track for your goals.
And rebalancing, that's bringing the mix back to your target. If stocks did really well and now make up too much of the portfolio.
Exactly. Maybe your target was 70% stocks, 30% bonds. If stocks shot up and now it's 80–20, rebalancing means selling some stocks and buying some bonds to get back to 70–30. It enforces discipline, selling high, buying low, and keeps your risk level aligned with your plan.
And we already talked about dollar cost averaging for handling market timing worries.
Right. Use DCA for your regular contributions to avoid the stress of trying to guess market tops and bottoms. And leverage technology. Online brokers offer amazing tools now. Research, analysis, automated rebalancing, tax optimization. Use them. Find a platform you like. Finally, stay flexible but stick to your core principles. Review your overall strategy maybe annually, or if a major life event happens. Marriage, kids, new job. Make sure it still fits.
So execute with simple, low-cost funds, regular review rebalancing, Lang Yumol, use tech, stay flexible, but principled. Okay, let's wrap this up. For someone listening now, feeling ready, what's the absolute first step, taking action today?
It's a great feeling, isn't it, having the knowledge? But knowledge without action doesn't build wealth. The potential is locked up. Successful investing starts with that first decisive step, not waiting for perfect conditions.
Bridging that gap between knowing and doing.
That's the key. And it starts with that personal blueprint we talked about. Remember, Rachel, felt overwhelmed but took action. Did the financial audit, set goals, broke it down. That blueprint transforms the abstract into concrete steps.
So what are those fundamental first steps someone can take, like right after listening to this?
Okay, concrete actions. 1, open an account. If you don't have an IRA or haven't enrolled in your 401k, do it. Just opening it is progress. 2, set up an automatic contribution, even $25 or $50 a month. Start the habit. 3, choose a simple, low-cost, diversified index fund for that contribution. Don't overthink it initially. 4, schedule a recurring time, maybe 15 minutes a month, to just review your finances. 5, commit to learning more. Pick one resource, a book, a podcast, a website, and start learning.
Those are manageable first steps. And what are the long-term pillars to keep building on?
Beyond the emergency fund and automation, a clear account structure, using those tax-advantaged accounts first, and a system for ongoing learning. Keep educating yourself. Use technology platforms offer education, reporting, automation, security, mobile access. All that helps support your foundation.
And this really is a long game, right? It's about habits.
Absolutely. Develop a sustainable review routine. Monthly check-in, contributions made, spending okay, quarterly review, performance, rebalancing needed, strategy still right, annual planning, big picture review goals, taxes, insurance, maybe estate planning down the line. Use tech for reminders, but understand your own numbers.
So it's continuous learning and refinement.
Exactly. Focus on incremental progress. Track quantitative things like returns and savings rate, but also qualitative things. How confident do you feel? How are you reacting to markets? Are you building good habits? It's a marathon, not a sprint. Start now, whatever you can afford. Consistently apply these principles. That first step from knowledge to action is everything. Your future self will be incredibly grateful when compound interest has worked its magic.
That is a powerful and motivating note to end on. We've covered a lot today: the incredible force of compound interest, how to harness it, the pitfalls to avoid.
From understanding the math to choosing investments, using tax advantages, managing psychology, and building your personal blueprint.
The key takeaway is that this knowledge is just the start. The real power comes when you act on it. So we encourage you. Review your situation, identify one or two small steps you can take today. Set up that transfer, research that index fund. Just start.
The potential to build real wealth over time is there for almost everyone who applies these principles consistently.
And keep learning. What questions do you still have? What areas want to explore more? Thanks for joining us for this audio lesson on the Deep Dive.